Investing doesn't have to be complicated. The best investment portfolio is the one you can stick with for the long term. Invest in low-cost global index funds and hold a balance of shares and bonds, to a ratio based on your ability to take on volatility and risk, and the length of time you will be invested. Over the last decade, the investment world has changed considerably, and it is now significantly easier to do it yourself, without the need for a financial advisor. Everybody has access to a plethora of investment platforms, providing access to a universe of passive and managed funds. You can then hold these funds simply and securely in one place, inside a tax-efficient wrapper, normally an ISA, LISA, or pension. To illustrate how to invest K.I.S.S, we will use the Vanguard investment platform vanguardinvestor.co.uk. Vanguard was founded in 1975 by the late John Bogle and is one of the biggest asset managers in the world. It is famous for low-cost index funds, and for keeping management costs low, to ensure that any returns over the decades are not gobbled up by a fund manager. Passive investing via Vanguard is all about investing in low-cost global index funds of equities and bonds. Index funds with no active management, hence passive. Global diversification to lower risk. Low management charges keeping costs down. If you invest in an ISA or pension via the Vanguard platform, the average fund management charge is 0.20% and the annual account fee is 0.15%. This is a total annual cost of just 0.35% per year. Investing K.I.S.S. Keep it simple stupid. The following 3 simple investment portfolios are available through Vanguard. Option 1. One fund. Very simple, set and forget. The simple option is a target date retirement fund, which is specifically designed for investing towards a pension. You simply choose a fund based on when you plan to retire and then let it run. Buy just one fund and own it till your dying day. It provides a balance of global equities and global bonds, and the balance changes automatically over time. More bonds as you get closer to retirement, lowering your risk exposure as retirement draws nearer. You never need to do anything, other than adding as much cash as you can over the years and arranging for withdrawal payments when the time comes. Vanguard's example starts at age 25 and ends with retirement at age 68. Allocation is 80% equity and 20% bonds for the first 18 years up until age 43. The portfolio gently de-risks until you are 50 to 50 by age 68. There is then a steep decline over the next 7 years until 30% equities and 70% bonds. Some investors believe the fund gets too conservative too soon, which is why we have option 2. Option 2, also one fund. Simple set and check occasionally. If you want to manage your own risk level, the next simplest approach is to use Vanguard Life Strategy Funds. Vanguard provides 5 life strategy funds which provide a fixed balance of global equities and global bonds. At one end is Life Strategy 100, which is purely invested in equities. Life Strategy 20 at the other end is 20% allocated to equities with the rest in bonds. Your fund choice depends on your attitude toward risk and your need for growth. Each Life Strategy Fund holds 6,000 to 20,000 equities and bonds from around the world with a bias towards the UK, and the ratio of equities and bonds is maintained constantly at a set value. Option 3. 2 funds. A little more involved. Option 3 involves using 2 separate funds with the understanding that equity provides higher returns than bonds but with more volatility. With a long time horizon, you can afford to ride the short-term ups and downs with a higher proportion of equity to achieve higher returns. You can hold both the Vanguard FTSE Global All Cap Equity Index Fund and the Vanguard Global Bond Index Fund, to a balance you decide. And then manage them over time, choosing to change the balance depending on your risk appetite and your time to retirement. If you are less conservative and less concerned by volatility and risk, you have the choice to hold more equity in retirement than option 1 would allow. The Vanguard FTSE Global All Cap Index Fund tracks the performance of the FTSE Global All Cap Index by actually buying and holding shares in 7,118 companies across the world depending on the size of those markets. The USA is the largest of the markets and comprises 64% of the shares. Japan is the next largest at 7%. And the UK is just 4%. The global fund is also spread across all the different sectors of the market: technology, financial, industrial, consumer, health, etc. Vanguard maintains the balance of the fund always at the same specified proportions regardless of markets and sectors' ups and downs. The Vanguard Global Bond Index Fund tracks an index fund of global government, government-related agencies, and corporate bonds from around the world with maturities greater than 1 year, and incorporates 14,554 bonds. Portfolio option 3 is for building wealth in a pension for retirement, or in an ISA for the now and future, and for post-retirement when you're spending your funds. Your pension is a long-term investment, so the opportunity is there to start with 100% equity and reduce the risk as time goes by. Your ISA is for both the long-term and short-term, so could be split into two funds. Long-term equals equity-heavy portion. Short-term equals bond-heavy portion. Holding separate funds has the advantage of being able to take money out of your pension or ISA when you need it, without having to sell at a loss. Because if equity is down, bonds are likely to be up, so you can take from the bonds, and vice versa. The truth about investing is that you can achieve life-changing results just by getting the basics right, with a global low-cost index fund, and then staying with it for a long period of time, to benefit from the magic of compound interest. Investing K.I.S.S. Keep it simple stupid. Choose which approach is best for you, and do it. You can find out more about investing in low-cost global index funds at gradragstoriches.co.uk. The #1 personal finance blog for graduates, showing you how to save and invest your way to wealth.